Some important financial terms. In this blog, we will learn about various terms which would be useful for having an idea about the basics of banking and financial awareness. 1. Open market operations. The open market operation is a necessary instrument of monetary policy. This instrument involves the process of buying and selling government securities by the RBI, Reserve Bank of India. 2. Cash reserve ratio. CRR is considered as some amount of funds that banks keep with RBI. If RBI increases CRR, the available amount of the banks gets down because of monetary effects. This method is usually used by the central bank to drain excess money from banks. 3. Statutory liquidity ratio. SLR is a certain quantity of liquid assets which commercial banks have to maintain in the form of gold or approved securities like bonds, etc. It is determined by RBI to ensure the solvency of a commercial bank and to control the expansion of the bank credit. 4. Repo rate and reverse repo rate. The repo rate is the rate at which RBI lends money to commercial banks. When the repo rate decreases, then it helps commercial banks to borrow money from RBI at a cheaper rate, but when it increases, then borrowing from the central bank becomes expensive. On the other hand, the reverse repo rate is the rate at which the central bank borrows money from central banks. 5. Moral suasion. RBI may request commercial banks not to give loans for unproductive purposes which does not add to economic growth but increases inflation.